Good afternoon, everyone. Uh, Welcome to this Zoom call. Thank you for taking interest in our new fund and especially taking out time on a weekend to join this call. Really, we appreciate that. On behalf of our entire team, I'd like to thank you all for participating in this call. So the way we have structured this call is, basically we have split this into two parts. In the first part, I'll briefly, share some highlights on our new fund. And in the second part, we will do an extensive Q&A. That will provide an opportunity for all of you to understand more about our fund and strategy and progress, our past track record, and also on the current market environment. Anything is, we would love to respond to any of the questions you may have on any of these. So the plan is to spend more time on the Q&A, less time on the first part, because as I understand from my team, I think my team has spent time one-to-one in terms of briefing the details and taking you through the presentation deck and all that. So I'll not spend too much time on that. I'll limit myself to, few, probably 10, 15 minutes on the opening commentary in terms of sharing fund details, and leave the rest of the session for really more useful Q&A. So that's the way we would like to take this session forward. So before I get into the fund details, bit of a context in terms of our fund. That will provide a lot of benefits in terms of where we are with respect to our alternate investment fund journey. Our first fund, if you go back and look at the first fund, was launched in 2019, right, just before COVID. And most of our clients, investors, came in the final close, that is during the peak of COVID, 2020. We closed our final close was done sometime in March, Jan 2020, right? That fund, we raised only about 78 crores to be precise, though we had a lot more investor interest in terms of raising more capital, because we said we will have a strategy of micro cap, that too market cap starting from 300 crores onwards at that point of time. We said we'll limit our fund size to below 80 crore, because as a thumb rule, if you want to invest in a market cap of 300 crore, which is 3x, the fund size generally is 1/3 of the market cap universe which you want to look at, which means about 100 crore is what is limits your fund size. So we didn't want to raise more capital, though there was appetite from our investors. We limited ourselves to only about sub 80 crores, and exactly it was about 78 crores, right? Now we are in the distribution stage. We have done 2 distribution on the fund. Probably balance will be done in the next 6-7 months. Overall, the fund which we raised about 78 crores currently, including the this partial distribution which we did, is around 200 to 210 crores. And in all likelihood, if our estimates are right, we would be closing this fund at about 225 minimum. Probably if we are lucky, then it can go a little higher. So we are talking about 3x plus kind of returns in the first fund. And while this fund was on, there was a lot of pressure from our investors to launch our second fund. Going back 1 year, 2 year back, most of the investors wanted us to launch a similar scheme. Looking at the kind of performance in the first fund, they wanted us to launch our second fund. But consciously, we decided we didn't want to launch another fund in the peak of the market, right? We wanted the market environment to be favorable to launch our second fund. Though we had our license from SEBI for the second fund in last June itself. So we waited till the market cooled down. And currently, I think we have an opportunity because the market has turned volatile post Trump administration took oath. So this is precisely the time we're waiting for. Now that the market has turned more volatile, the environment is more uncertain, the valuations are turning more favorable. Though still it is expensive, but they are turning more favorable compared to what it was about 1-2 years back. So we said we'll launch our fund. And this time too, in this new fund, again, we are not going to be, looking for a large corpus. The microcap definition has changed the last 5 years because market levels have moved up. what used to be sub 500 as micro cap in 2020 or 2019 now is about 1,500, right? So there is a 3x kind of overall market level improvement in the last 5 years. So now we are looking at 1,500 as our kind of universe in which we would like to invest, which means we don't want to raise beyond 400, 500 crores. So we would like to limit the fundraise in the second fund too to about 350, 400 crores, not more than that. Though we have a green shoe option, our objective is to not to raise too much money because we are more interested in building a portfolio in that sub 1,500 crore space and delivering that alpha, which will create our larger assets for us. That's our strategy. So to that extent, our fund size we are looking at 350, 400 crores. The good news is the first close, which is closing by this month end, we are well on track to raise about 150 to 200 crores. Already we have closed about 100 crores and we have about 50 crores in pipeline. And if luck favors us, probably we'll be closing somewhere closer to about 175 to 200 crores in the first close. And the final close is about 1 year away. So overall, it should not be a challenge for us to raise the kind of corpus target we have for the second fund. The more important significant development which you would like to share with our prospects is that 90%, almost close to 90% of the fundraise in the first close has come from our existing investors. Either they are our existing investors in PMS or they are already an existing investor in AIF. That is a real testimony for our process, for our journey, and for our performance. And that's the context which I want to give. Before sharing a bit on our fund 2, in terms of investment approach, strategy, I don't think there is any there is a significant difference between the fund 1 and fund 2, nor PMS. Overall, we are still sticking to value investing, deep value investing. So in that perspective, there is no difference. We are always, the overall fundamental philosophy of looking deep value from the broader universe of small and mid caps, there is no change. The key change in our fund strategy is to look for the lower end of the spectrum. The stock selection will be from the lower end of the spectrum. That's one key change between PMS and AIF2. And second key change, because I'm trying to give this details because most of the times investors are asking us, why do we have an AIF structure when already you have a similar strategy in PMS? The key difference between PMS and AIF, which I would like to highlight, is the concentration level. If you look at our PMS strategy, the number of stocks in our model portfolio would vary between 24 to 26, 27, right? It's reasonably diversified kind of a strategy. And if the investors stay with us for very long, which is what 95% of our investors are, most of our investors are there with us for more than 10 years. The portfolio number of stocks in those kind of mature portfolios have been there with us for quite some time. It could go even up to 30, 32 stocks. So it's reasonably diversified. We don't take any single stock position beyond 4 or 5% unless there's a huge conviction. Even in those kind of cases, we don't go beyond 6, 7%, right? Whereas AIF as a stated strategy is a more concentrated one. So the overall number of stocks in a model portfolio is unlikely to extend beyond 12 to 14. That is one. And in a single stock kind of an opportunity, our starting kind of allocation would be somewhere between 8, and it will go all the way up to 10. Though we would love to allocate more than that, the regulations don't permit beyond 10% of the corpus in a single position. So it's a lot more concentrated strategy, and it is going to come from the lower end of the market spectrum. PMS, if you look at the average market cap, would be somewhere between 5,000 to 6,000 crore, whereas AIF would be somewhere between 1,000 to 1,500 crores. So it's the lower end of the market spectrum and reasonably high concentration. The reason we have done that kind of structure is to deliver higher alpha, right? So in this kind of strategy, what happens is your picks do well. It can do it can give you a disproportional share of returns to your overall value creation. So that's one of the reasons. And because it's a concentrated strategy and it is on the lower end of the market cap, we also wanted to have a hard lock-in, right? Hard lock-in in the sense that it is almost like the doors are closed for investors. They have to stay with us. And we also need a much longer time than a open-ended fund. So that's the reason why we have gone ahead with the AIF kind of structure, which provides that kind of a framework for us to go for a hard lock-in and also a longer kind of tenure. From the first close, we are talking about 6 years for the fund to start distributing it, which is reasonable time where you can really take a high allocation, high conviction position, and wait for it to unlock gains from those kind of investments. And another interesting perspective on an AIF structure, which again one of our investors gave, which was a little revelation for us, is that investors by force are locked in the fund. In a way, they are forced to ignore the kind of noises which come on the market once in a while, and they are forced to be, locked up environment so that they can get the benefit of power of compounding on a longer duration. So these are the reasons why we've gone in for AIF kind of structure, and primarily, as some of the brief highlights on the AIF fund, which my team would have shared with you, is it's basically early stage investing, something similar to private equity kind of investing, early stage investing, but in the listed space. That's how we are positioning our fund. So we are looking for early stage identification of growth companies which can really scale and then deliver that kind of alpha, something similar to a PE kind of strategy, but in the listed space. And also we will have a fair share of allocation, not very large, but a fair, about 15 to 20% share of allocation towards pipe kind of a structure. Pipe is, though the term sounds very sophisticated, primarily it means, private investments in public equities. That's what pipe means. It basically refers to the execution part of the strategy. It's nothing to do with the stock selection. In some of the cases where the volumes are less, the liquidity is less, we want to build a position, right? 10% position on that kind of a new opportunity where you don't get enough volume in the secondary market. We tap the primary market to get it. Primary market in the sense, not the IPO kind of a space, but the primary market in terms of preferential allotment, where we talk directly to the promoters, try to get direct allocation through preferential allotment so that you can get those required volumes. So that is, we are unlikely to have more than 10-15% of our allocation towards that part of it, but it will have a reasonable share. The other advantage we would like to share on the AIF fund structure, it's a pooled vehicle compared to PMS. PMS is on the individual investor name. To that extent, the execution can be really agile and more flexible in AIF because it's a pooled vehicle. Also, when we are looking at tactical and special situation kind of opportunities where we look at cash parking, like for example, we draw down money and then our long-term positions takes time in terms of identifying those opportunities. Meanwhile, you want to park that. Instead of parking it in a liquid fund and earning that 5-6%, we look at arbitrage, a special situation, or tactical opportunities where you can eke out slightly higher returns, but without taking too much market risk. Such arbitrage opportunities are a lot more easier and flexibility wise, a lot more efficient in terms of executing through a pool structure. Be it open offer, buyback, all these processes involve tendering of the stocks. And unfortunately, PMS being non-pool structure, those kind of executions are not easily possible. So we forego such opportunities. In AI structure, since it's a pooled vehicle, we can tap those opportunities much more in a faster and agile manner because of the pooled structure, and also get more out of those opportunities by tendering those stocks in those opportunities, right? So that way, this particular framework is a lot more efficient to deliver that additional returns through tactical approach. Overall, in a AIF kind of a framework, our mandate is to deliver at least 200-300 bips higher return, that is 3% higher returns compounded, higher returns than a PMS kind of a mandate. In PMS, our mandate is to deliver somewhere around 18-20% compounded return over a period of time. though not in a linear fashion, as all of you would understand. It comes much more in a non-linear fashion, mainly most of the times in a back-ended fashion. And this kind of mandated returns of 18-20%, we would like to deliver at least 300 bips alpha in an AIF structure. And mind you, in AIF, I think other advantage with which investors should be aware is the returns. What they get is a post-tax paid returns. And the hurdle which we apply is again a post-tax paid hurdle. So to that extent, even though we might say it is 200, 300 bips higher return, on a post-tax basis, it will be slightly likely to be little more higher because there is a tax element which takes additional hit on PMS. So that's the overall kind of highlights I would like to give on the fund. Before I open the floor for Q&A, what I thought is I'll also take a few minutes and then uh, cover some of the typical questions which investors generally ask in this kind of fund and in this kind of strategy. One is generally people wonder, why we stick to only small and micro caps. That's one question I would like to preemptively respond and cover it so that we can save the Q&A for other questions. Second is current, uncertain environment. What's our take on the market? These are typical two questions which we would like to, and then cover it as part of my commentary in the opening session so that we can spare the Q&A for a better, more engaging, more useful questions. So coming to small and micro caps, of course, a lot of people wonder why we have stuck to small caps. It is not today. It's since our inception for last 20 years, we have done nothing else small and micro caps. And we have no other schemes. If you look at PMS, we have one single scheme, which is a deep value scheme on small caps, slightly larger end of the small caps. And AIF, we have one AIF which is getting over, and the second one again on micro cap, which is on the lower end of the market cap. Both are deep value investing space. One is concentrated, one is little more diversified. Our view on small cap is like this. There are two ways to look at small caps. One is, look at this as a very high risk space, altogether avoid it, right? That's a very conventional view. And of course, when you take that view, you're also saying no to the alpha generation, right? Small caps at the end of the day deliver higher compounded returns over a longer period if it is well constructed with high quality small caps. So by saying no to small caps, you are saying no to the alpha generation. The second view is second option is to take more contrarian approach, also, but very objective way to look at small caps. That is, try to mitigate the risk build a process to mitigate the risk in that space, and take the pain to understand the risk and eliminate those risks. Then I think you get rewarded for that, painful process by getting higher compounded returns. And we have chosen to take the second path, though it's a very challenging space, lot more painful. You got to turn around so many stones to figure out that one or two gems in the small caps. But we said we will do it because over a period of time, the value creation in small cap can be exponential. Let me give you an example. In a large cap, well qualified portfolio, right? Over a period of time, it can deliver 11 to 12%. Well qualified, good portfolio, active portfolios. Same if you do it in a small cap, high quality small caps, well constructed portfolio, if you stay long and unlock gains, it can deliver close to about 18 to 20%. And this difference of 600, 700 bips over when it gets compounded over a period of time, it can create exponentially large value for investors. That's the way one creates wealth. In a large cap portfolio, when you do it this way for about 20 years, it can create 30x, 35x, or 40x max. Same thing when you do it on a small cap over a period of 20 years can surprise you with 75 to 100 times. So you're talking about a difference of 100x and 40x. That's a huge difference in terms of final value creation. That's a real wealth creation in spite of all the challenges. That's precisely the reason we stuck to small caps, and we would love to do that because we get a kick out of stock selection. We are very passionate about bottom-up stock picking, and that's our core competency, and that's in our DNA. That's why we have chosen to be road less travel kind of a path, and we have been reasonably successful. And entire journey of TrustLine, we have done nothing else but value investing, that too in small cap and micro caps. We have built a very, very powerful story in small cap investing and in that niche value investing space. And that our long-term performance track record, if you look at, that tells the story in terms of how we have delivered that kind of value creation. In PMS, in 17 years, we have done about 18x kind of net returns, net of all expenses to our investors. And even if you look at our asset under management, we are at about 1,000 plus crores assets. Out of that, I would say about 70% has come from value creation, not new money. So small cap, in spite of all that, it is a very interesting space. Like one of our favorite saying is, in small caps, if you avoid landmines, what you are left with is gold mines. So what you are left with are gold mines. So in our case, I think we have built a huge due diligence process over a period of 20 years of investing and focusing and building expertise in the space. We have a reasonably very robust process to eliminate risk in the small caps. So our entire focus in small caps is not to look at gold mines, but to our entire focus is to avoid landmines. Anyway, the rest what we are left with are gold mines, and that's the way we treat our entire investing strategy. So that is on that question which typically investors ask. Second, on the market environment, of course, it's a very challenging environment. I would like to address this in two parts. One is to look at the market in the short term. The other one is to look at Indian context, I'm saying, in the medium to long term. In short term, because of all this noise around tariff and tariff war and the kind of uncertainty it has created for US global growth as well as for US GDP growth, the earning growth, what you can look at for India is going to be subdued for a while. There is no taking away from that fact. In spite of the de-escalation in the tariff war, now we understand that there is a lot more toning down in terms of noise levels on tariff. China is willing to talk, and there are a lot of exemptions on tariff. This post-liberation day, you have this 90 days pause, and there is a lot of progress in terms of bilateral trade talks with many countries with the US. In spite of all this diffusion, in terms of de-escalation, I would still say the short-term growth prospects for the global growth is going to be subdued. For example, the forecast for US pre-tariff war used to be 2% plus GDP growth. Now people are talking about 1.1%. So when the large country grows slower, it's going to take the toll on the rest of the world. So to that extent, I think the short term is going to be volatile. Growth prospects are going to be subdued. Corporate earnings in the short term for India too will suffer, which means the market is unlikely to run away in the short term. It is going to be range bound, sideways, or whatever you call it, but you could have stock specific opportunities, but unlikely to have a momentum in the short term. But the second part is to look at the medium to long term. There, I think things are a lot more favorable for India. One, India is less export driven. It's largely domestic driven economy. If you look at it, only 11 to 12% of GDP is exports. And if you look at only US exports, it's somewhere around 2%. So to that extent, we are largely insulated from the global trade frictions. We are more consumption driven, that to domestic consumption driven. So to that extent, that's going to be one tailwind for us. Second, with all these tariff tantrums, one good thing which has happened is dollar, which used to be on a rally and it used to be strengthening, it has reversed direction. And as a result, it used to be at 108. Just in 2 months, it has come all the way to 98, 99. That has taken a lot of pressure from the currency in the emerging markets, including rupee. All right, you must have seen that rupee hit a 7-month high yesterday. 80, it came below 84. But for RBI intervention, but probably it was close below 84, but RBI intervention somehow made the rupee to go back to 84.3 or 84.4. So that's a kind of environment today, which gives a lot of leeway for RBI to cut rates. We have already seen the cut after the new governor, and which means RBI can take a lot of liquidity boosting measures. Also, it can probably have accelerated cuts now because the inflationary outlook has changed. Look at the crude oil. It is who would have imagined that Brent will go below 60, though it has come back a little above 60, but Brent is now below 60, which means, and you have a good monsoon prospects for India this time. So all that put together, food inflation, fuel inflation, is going to drive inflation downwards now. The outlook has changed. In that kind of outlook, RBI can, as you know, from neutral to loosening stance, and you've already seen some cuts. Probably now RBI will be a little more relaxed in terms of looking at the terminal rate of 5.5, which wouldn't have been possible last year when US yield was elevated and dollar was rallying to higher levels. So that environment means you are going to have a lot more liquidity. You are going to have a monetary cycle easing, which is kind of a preamble for bigger growth coming, 6 months or 2-3 quarters down the line, which means you are looking at a much better days in terms of GDP recovery. Plus, you have bilateral trade. There could be some good news between US and India. So India is a lot more relatively better placed in this kind of environment, and this is China plus one, which could also be a little bit of tailwind in terms of manufacturing for us. So if you look at medium to long term, there are a lot of opportunities which one can identify, which will help in terms of value unlocking. But in the short term, there's no taking away from the fact that it is going to be volatile, it is going to be challenging. And we are launching this fund at the right time when the short and medium, short-term outlook is little murky, and that means the markets are likely to be volatile, which will give you more opportunities, which means it will give you a lot more time to build the portfolio. This is exactly the phase we wanted before launching the AIF2, and that's there in front of us, which means we'll utilize and capitalize this uncertain environment to build portfolios and high quality micro cap portfolios so that we can unlock those gains in the next 5 to 6 years. Thanks a lot, all of you. I think it's a good participation. I really enjoyed responding to most of the questions. And our team is in place. Mr. Govind, Mr. Ramesh, and Mr. Parni and Arun Lal, all of them belong to our business development team. They're always available. And any more queries, any clarification, they are there to address. In case if you want to have a one-to-one call with me, just to get more conviction on our strategy and our fund or our journey, we can, I'll always would love to have such a one-to-one session. My team can schedule such calls. Please feel free to approach us in case we need anything more. And I really appreciate all of you joining on a weekend. Thanks for participating in this call. Thank you once again.
For more videos, subscribe to our YouTube channel for our regular updates and follow us on other social medias.